Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Len Tannenbaum, founder of TCG. Len, it is great to see you. Thank you for your time, and it's great to meet you, at least virtually here. Really appreciate the time, and I'm looking forward to our conversation.
Thanks, Todd. Great being here.
So I think it would be helpful for the audience. Maybe we would just start with a little bit of your background on Wall Street, kind of where have you been before becoming founder of TCG?
I've gotten old, so it's a long background, but I was a Merrill Lynch analyst. I was a Pilgrim Baxter. I was a junior partner in a hedge fund. And at very young age, 27, I started a wonderful company named Fifth Street, which grew over the next short, 20-year span into one of the larger middle market credit operators. So what we did was we're about $6 billion of assets, which was big 10 years ago, but it was. We were public companies. We were a CLO business, asset-backed business. It was really terrific. We had about 100 employees located in Greenwich, Connecticut. And I sold that company in 2017 to Oaktree. The great thing about that, a lot of my people went there, and they've been successful there. And I just had a Fifth Street alumni meeting, and the amazing thing and proud thing that happened was my people have really done terrifically in private credit. So private credit background, I sold the company, took a year off, played with the kids and deepened my relationship with my family and relaxed, which is everybody needs that period in their life to do. And then fast forward a little bit more, right? We had COVID, and COVID was a wonderful experience for our family where we were all together. I had all my kids in the house, and a lot of people actually look back and say, wow, it's amazing to take a year break in the world and be together every day. And I'm an entrepreneur. I love coming up with ideas. And I came up with this idea to start a company. And I said, well, okay, let's show the kids how to start a company. And not only did I show the kids how to start a company, I showed the kids how to fail 5 times in starting a company. And that was kind of fun. But we were the first cannabis lender to list on the NASDAQ. And it was amazing. And it was exactly as it should have been, where the investors had amazing experience of investing. Stock trades up. It was way oversubscribed institutionally. It's just an incredible experience. Ring the bell again. Show the kids how to do something from absolute scratch and concept to finish. Amazing, and it was just fantastic. And so that continued. And then I said to my wife, who is my partner, and Rob and I have 2 wonderful little babies together. I have 6 children. So
Wow.
Yeah,
I got 2, and
it's a lot of work. Yeah.
Yeah.
6, I've got 6 from 26 to 2 years old. So
Wow.
it's a great span. And my wonderful partner and wife, Robin Tannenbaum, I said to her, choose my partner in this business. I said, we could sell it, travel the world, have a great time, or we can build another asset manager, this time better than the one I sold to Oaktree in 2017. And I think, there's some things I would have done differently. There's some lessons learned. I'm a little bit older, a little bit more mature, less egotistical. And so this is like, do you want to do this with me or not? And I swear to God, and it's true, if she said no, we sold the business. We had a great bit to sell it and be done. But she said, yes, I want to show my daughters what it is for a mom and partner and business partner to start a business and grow it. I think it's very important to do that. And so we decided to, again, grow an asset manager, which is what you see above you, TCG.
Well, I appreciate that intro, and I think it gives a lot of great context, to your career, and just maybe going back a bit, given that you were a pioneer in the BDC space, kind of how different does that market look today versus when you were kind of in the early innings of it, and do you still see that as a compelling strategy?
I mean, it's just amazing how institutionalized this whole industry has become. Since I sold, I think it's up 4 to 5x in terms of size. It's become absolute mainstream. There was recently a conference that I was at, and they said, raise your hand if you were within the last 5 years investing in BDCs and alternative credit and private credit. 80% in the last 5 years and never done it before. 80% of the audience, 80%
Wow.
had never invested back when I was actually lending to the private credit industry. So monumental change, and I'm really amazed. And I've seen Lawrence Golub and others since then. And I said, look, congratulations, guys. And what Mike Arrighetti has done pioneering this for Ares, and he was a peer of mine 20 years ago. It's just incredible what these icons of the industry have done and how they've built amazing firms. So am I a little jealous? Sure. But incredible how much this has progressed.
So with TCG, I mean, was there something within the private credit space that you guys saw as a specific opportunity of like, hey, let's explore this within private credit or that? I mean, tell us a little bit more about kind of that the story of like, all right, let's jump into private credit with TCG.
Well, before I jumped into private credit with TCG, I had a 5-year non-compete. So we did something that was outside of my non-compete. We did real estate. And I first thought I could do it myself. Oh God, it can't be that hard, right? Porting private credit expertise to real estate lending. It should be sort of, close to the same. And I can't tell you how wrong that statement is. It is entirely different. Fortunately, God saved me, and I have 3 deals that I thought about doing. I didn't do in diligence because all 3 would have not been great. And what I realized very quickly was, wow, this is entirely different. And need a real expert to do this. You need an amazing, credible person. So I did a retained search, and I said, find me the best and the brightest. And I was lucky enough. So we're in Palm Beach. We moved to Palm Beach, live in this wonderful place. We're sitting in our office in West Palm today with over 42 employees. So we've built this great firm. But in Palm Beach, the problem is attracting the talent is now easier. It's getting easier and easier, Wall Street South, but it's
Yeah.
not as easy, right? You're still not New York. And so we went to this retained search, and I found this wonderful guy named Brian Cedrish. And Brian, 50 years old, lives in Boca Raton, similar sort of thought processes. We sort of courted each other for 4 months. He was looking to leave his amazing firm, which is related, the one run by Steve Ross, where he helped build the $6 billion lending platform. And I decided this guy is like 900 times better than I ever could be. Amazing reputation, super hard charging, killer attitude, ex Goldman Fortress, that, this, and that, perfect pedigree. You know, I got to get this guy. And I said to him, look, let's be a partner. Come on in. I'll seed you with a lot of money. We'll backstop all of the deals, and we'll build a business together. And it's been an amazing experience. So the first step was not private credit. The first step was real estate lending. By the way, a lot of these private credit guys and BDCs are investing in the same stuff. They're investing in real estate
Yeah.
deals, real estate lending deals. So there's some overlap, but that's about it. To manage, to asset manage, to understand it, is to have those contacts, reputation is different. So that's my first business, and that's done about $1 billion of deals in the past 12 months. So 8 people, took the second guy from Related, full-time construction expertise from them, just hired a head of asset management, just an amazing team that I get to learn from. I've learned a lot in the last 2 years, and I get to invest with and make money with. So that's platform one for TCG. Um, Platform two is semi-private credit. It's our interval fund, which is our liquid product, opportunities product. And you see a lot of guys in private credit do this type of product. You saw BC Credit, right, and Ted Goldthorpe and Evelyn Dimitrov, who's a partner there, who used to be my CIO, do this in their big opportunities fund they've raised with over $1 billion. where they can go. It's smart because it's a sort of more go anywhere fund that you can zig and zag and take the best alpha returns without being pigeonholed into a set strategy. So, I think that that's a really smart thing to do, and I think that's
Mhm.
been copied a bit. But and the third one, and we filed it last week, so you get real news, real timely
All
news.
right.
Is
Breaking
we'll have a
news.
we'll have a BDC again with the proxy is public, where AFC, the first deal that we talked about, will turn into a BDC, ultimately widen the mandate, invest in private credit, and we're going to look to do that on a new platform. And I've hired a wonderful woman coming down from New York. I got her to move to Florida too, to lead the credit team. And I've got Dan as my partner, who's our CEO there. So I've got that third platform. So think of us as real estate lending, opportunistic credit, private credit under one roof.
So, you have a unique viewpoint. You've been an LP, a GP. Does your approach to the market differ from each of those seats?
I'd never really been an LP though until I sold. Like I had a little bit of money, but
Yeah.
all of my money was always in my company. And then you sell the company for all cash. By the way, thank you, Oaktree, for paying me all cash. And uh, and now you have a bunch of cash. You have no company, you have no people, you have no. You're like, okay, now what do I do? Right? What am I supposed to? What do I do? Because I'm so used to running a company. I'm not used
Yeah.
to managing money and managing just a pile of money. So I did, it took a year or so and I thought about it and I have done what I've always done. I put all of my money back into my companies. So we are the largest, different than every other, I shouldn't say every, almost every other asset manager out there. And I mean BlackRock and Blackstone and Ares and Apollo and all of them. These guys are managing funds. And what's their GP percentage? 1%, 2%, maybe they're 5%.
Hmm.
I understand it's a lot of money because their funds are enormous.
Yeah.
But as an investor, you're investing primarily outside investors they're getting a fee from. And they're not really managing the most of the fund is not their own capital. Much of their own capital could be in the funds, but like that fund is not most. So I'll give you an example. In the BDC, I own about 23% of it. In our private REIT, I have 30%. In our public REIT, I have about 25%. In in our interval fund, I'm seeding it personally with 100 million of my dollars of my own money. So when we take outside investors, it's investing alongside us.
Hmm.
And that's changed. I've always had a decent investor mentality. Today, I have a phenomenal investor mentality. Should I have always had a phenomenal investor mentality? Probably. Not everybody's perfect, but whether we make fees or returns, I'd rather make returns all day long because it's our capital that's invested alongside all of our clients, and that's a very different change in our approach, and it's created a very investor-friendly mentality in terms of and right now, TCG is amazing. We've got over $1 billion in management. We're growing quickly, 42 people. The external manager doesn't make any money. I spend it all on resources. So that just goes to the whole point of, right, we're doing the best we can for our investors and our investor return.
Now, speaking of growth, private credit has certainly had a meteoric rise, you could say, since the end of the GFC. What does the next evolution of that space look like, and are public and private opportunities still differentiated enough? So I think that's a common theme kind of coming up a little bit more. Is like, is it worth the are you getting excess for taking the risk private, or are they starting to kind of bleed a little bit into each other?
Look, we used to say the middle market was $20 million deals. Today, people are still saying they're in the middle market and doing $200 million deals.
Yeah, I know.
That's not true, right? The middle market's moved up,
Yeah.
and those deals are all clubbed up. They're all syndicated, and there's very, very few single let deals, and they have compressed in terms of yield for sure. A lot of these companies are stressed and distressed. You can see that in the PIK as a percentage of income in the private equity world go up from 8% to 14% and rising. Look, I sold, and public information because you can see my filings, right? I had a ton of Oaktree stock. because I owned a lot of Fifth Street, and that became Oaktree stock, and I sold it all at $18 or $20. The stock's in the 13s. So it's people are recognizing that this private credit bubble, and people have been talking about it. It's in Bloomberg, it's on CNBC,
Yeah.
and so and so. Now, will it burst is the question. And if it does
Hmm.
burst, what does that mean? And how and who gets hurt and who doesn't get hurt, right? And I'm not going to opine upon that too much because that's not, the perfect thing to do. But you're
Hmm.
right. There's a big bubble. Where there's not a bubble and where we see the opportunity is where I started 20 years ago as a lower middle market player. There are no reputable lower middle market players. There just isn't. The most reputable private equity sponsor that stayed in this market, I told Stuart how brilliant he was for doing that, is a Riverside company. So Riverside company is 17 billion of assets, and they still really do lower middle market private equity. It's just amazing. But they're not $100 billion, $200 billion firm like they could have been because they stayed in the market that
Hmm.
made all the money with an amazing discipline. I think we want to go there. We want to go back to the lower middle market with, lower interest debt plus warrants and think about helping smaller companies grow with all of the learning and expertise, getting real operators by my side, which I didn't do the first time, but I'm going to do this time, and be our partner with smaller private equity. That's how I want to do private credit. And then opportunistic credit's really cool. I'll give you an idea, flavor, because you like deals, Todd. So I'll give you a
Yeah.
flavor. Johanna found this deal that we're contemplating, which is a land deal. So it's crossed with our real estate team. So the real estate team is helping. So that's the other great thing about having multiple expertise here is in California. And this land has all these oil wells on it. You got to plug the oil wells. You got to deal with the environmental stuff, and you got to get reapproval in this really great area to build something. And if you can do that, there's massive value add to this. And it's a developer Johanna's worked with before, and he needs a 1 year bridge just to get the land entitled. Then he sells the land. And first, before we go in, he's going to sell two parcels for 110 million. Then we're going to give him a bridge potentially for 70 million. I haven't been through diligence, but I'm telling you the types of deals.
Hmm.
And that would just be amazing. And as we get our return, it's a complicated deal. It takes our real estate expertise. We happen to know the people in the deal already, or Brian does, using your contacts, using those relationships, finding opportunistic opportunities and getting paid for it versus run-of-the-mill private equity, 300 over, 400 over, multi-syndicated middle market, and charge too much fees for it. That's not a game I'm going to play.
Do you potentially see that as kind of a follow on to your comments there as an area that begins to maybe get a bit more competitive in the next few years? That
No,
lower middle market, or is
never.
the scale and the focus just going to be on LPs, insurance companies? They're just throwing money at the large firms, and it's just continuing in that vein.
Look, the large firms are crushing it.
Yeah,
I mean, Owl Rock, we have 5 people from Fifth Street at Owl Rock, our former employees. They're doing great. I mean, what they've built is a machine, and you can't, it's just a marketing machine, but also they've hired really brilliant people to backfill, a lot of capital, and it's very, very interesting what they've built, and they are for them to do a deal that's small, they just can't. It's just too much time. It's the same amount of effort to
yeah,
do a $30 million deal as a 300, and they've got to put so much money to work that it doesn't make sense for them. So I think, look, everybody starts there because it's the best returns, the best risk-adjusted returns, and the least scalable. And then once you generate that, everybody wants to scale it. And I'm not saying we don't, but for the foreseeable future, and also since it's so much of my money in there,
yeah.
returns are so important versus scale. Because if I get the returns, that's what's important.
So, in terms of the credit environment we're in today, kind of where do you see that going? Where is the current credit cycle unfolding, and kind of where would you say we are in it right now?
I mean, let's talk about real estate first. Then I think what's happened in real estate is going to happen in private credit. I can't tell you how many developers are wiped out. It is baffling to me. By the way, these developers are brilliant, hardworking, thoughtful, creative people. that have literally lost all of their money, many of them, by backing liquidity covenants. And remember, different than private credit, when we do real estate lending, we get personal guarantees to complete the product. We get personal guarantees to carry the interest. We get personal guarantees, bad boys. Private credit, it's not even covenants. There's covenant light. And
Yeah.
we get PGs and tons of covenants and the ability to call a rebalance any times. I love this business. This asset-based real estate business is amazing. So we are watching, right? One of the big things is we need the liquidity from our backer, for the people we lend to, and we need their net worth. And we get this certified quarterly. And it's really evaporated because their projects have gone south. They've had to put tons of money into their projects. Insurance costs are up. Costs of materials are up. And delays always happen and are
Yeah.
unforeseen delays. So that's really an industry where we're finding great value. And there's not a lot of lenders there because it's very complicated and you have to be really great to do it. And fortunately, have the right team, right? So port that into private credit. Will you see that type of distressed scenarios come out in those opportunity sets? Not yet, because there's way too much capital chasing too few deals, and the transactions aren't happening because too many people are underwater and nobody wants to do equity underwater and crystallize it. All the private equity firms, some private equity firms are hoping, gee, maybe I'll get bailed out over time, and all of that. And that's why you haven't seen a return of capital. We're part of a YPO family office group, which has over $50 billion of assets. And in that group, the biggest complaint coming out of the large family offices in America and Canada and Panama, et cetera, are there hasn't been a return of capital from private equity and a long time.
Yeah.
Like there's no dividends. That's why secondary funds have done well.
Yep.
So private credit are the lenders to these guys not returning capital because they can't sell the companies. So you're seeing high interest preferreds and PIK securities burying the equity further. So what bails that out? Well, maybe this market, which is already up a lot, bails it out by going higher and getting value and getting, an exit, and maybe not. So Todd, we'll wait and see.
Is there when it comes to the borrower profiles that kind of fit within the space that you guys are in, what do they look like? What does the typical borrower look like in the private credit space where you guys play?
Again, I love right now, we've been so big in the asset-based lending that a borrower could be a 75% loan to cost, loan to value type idea where there's 25% equity, but all those guarantees on one of my favorite deals, which is both in the direct lending portfolio and the real estate portfolio, which is a place right here in Palm Beach called Panther National. So Panther National is a fun one to talk about. It's a golf course. And it's a great golf course if you haven't played it, or viewers. If you go to Florida, it's a golf course with the best contours. So the highest elevation changes, I think. A big family out of Germany backed it. They're big skiers. So think about in the north, you guys got this, but in the
Yeah.
south, we're very flat, right? So to have all this contour on a golf course is amazing. You all should play Panther National. Around Panther National, we're building houses, right? These houses are selling for 5.5 million. The memberships are selling for 500,000, and they're selling. So what did we support by this loan? We supported a clubhouse that needs to be built, a golf course that's already been built and played on that's well regarded, and the home building business around it. And so a home comes in Florida, you get a 25% deposit, and that's non-refundable, and we're secured by that deposit. Then we got to complete the home and deliver the home, and the line gets paid down. So that's half of the loan. I feel very good about that because at worst, you own a bunch of houses 25% cheaper around this amazing golf course. That's the worst case scenario. So far, so good. The other side of it, right, is you have the home development business, and they got to build this clubhouse on budget, on time, and all of that. And so we have guarantees around that, of course. And the good news is the backers of the golf course really care and love what the property is and have put the time and money into making it work. So that's what you have to bet on. Just like you bet on an equity sponsor here, you bet on a direct sponsor. Um, So we really haven't, we're now entering the sponsored business. I wanted to call my old partners at GTCR and Riverside Company and great private equity firms that said, guys, would you work with us again if we get in the industry? So we haven't launched yet. So we're going to launch. That's not come yet. We have our main business right now is real estate lending still. We're opportunistic credit, also public information. We'll come out with our interval fund probably in November. So we're excited to do that. So it takes a long time to rebuild a business. I had a great business that I sold, and rebuilding from scratch is not a quick exercise. It's brick by brick.
What about the commercial real estate space? There's certainly been a lot of stress in that market. Obviously COVID changed in a lot of ways the way we work. Not to use the term we work, but changed the way that we go to an office. And there's a lot of hybrid working now, half home, half in the office. Has the commercial space stabilized a bit? What does that look like today? And is it still in a precarious position as say maybe a couple of years ago it seemed like it was on the verge of collapse?
Oh my goodness. We're talking about New York with Mamdani, or we're talking about, the states we invest in. So we don't invest in the North. We invest in the South. So we're in the southern states, uh, in our public entity, Suns. And so SUNS invests in Texas and Florida, Louisiana, Tennessee, these states that maybe are more people coming there. You're seeing greater growth. You're seeing lower taxes. You're seeing more freedom. And we're focused there. Having that backdrop of growth and prosperity really helps. I love Florida. Most of half our deals or so are in our backyard, and that's usually what Warren Buffett said to do: invest in your backyard first. Brian, of course, working for Steve Ross, who's an icon here in Palm Beach and built
Yep.
up Wall Street South, comes from that Florida background. So we love investing in our state, and because of that, I think it's a lot easier. The absorption's better. Not in Austin. Austin's got oversupplied, for example, in Texas, but in many markets that we're in, the absorption's better, the economy's better, and so and so. I think there has been a lot of real estate, as we talked about right earlier in the program. There's been a lot of real estate volatility and developers with real issues, money running out, foreclosures, takebacks. A lot of office and all Class B office really has been stressed. Fortunately for us, we're at zero office exposure, so that's good. The only office we did do Shell headquarters in Louisiana, but that's not really office. It's an A credit sort of triple net lease for their headquarters. So let's not call that. If you call that office, it's office, but I don't think so. I look at a
Got it.
triple net lease tenant. So I'm really pleased with our positioning. Having said that, and if you talk to Brian, probably next on your program, if you want to talk more about real estate, our great CEO, Brian's been sort of pushing like, look, we're ready for office because the prices have come down.
Yeah.
Now enough has been disposed of. It's not so bad anymore to invest, to lend to office. And so that's exciting, to now look at those types of deals that we haven't looked at. So far, we've been 65% residential and multifamily. We've really taken advantage of the dislocation and gotten really good rates, and are not really starting to see the banks come back, unfortunately. But the banks were out of it about 6 months or a year ago. Now they're being more aggressive.
When it comes to interest rate or credit spread volatility, how do you guys position to hedge against some of that?
I hate hedging. I feel like I always lose money every time I hedge against anything. All these people doing swaps and swaptions and all that other stuff. And remember, I'm investing my own money here. So, just understand the risks you're taking. So we're very well positioned from floors. So we have floors on our deals. Average floor is about 4% or 4.25%. And as interest rates drop, as now we think they will,
Hmm.
right? We're going to benefit from that. The floor on our senior revolver, which looks a lot like a BDC or a private credit revolver, is 2.6%. So we'll capture some net interest margin as interest rates decline. Almost all our loans a lot of them are floating, or almost all of them are floating. So that's great. So floating with floors is where you want to be. If interest rates are zero, maybe not. But if interest rates are high,
I don't think we're going back there anytime soon.
yeah, I hope not.
Yeah.
Interest rates are high, then we're good. So we like to earn some money. We like high interest rates. It works out well. So I think we're well positioned. We're not counting on it. I think a lot of real estate people were, though. A lot of people thought that you could bailed out in 25. To stay alive till 25 was a big thing, and they're dying because here's 25 and the interest rates are still high. So
Yeah.
I think if you're banking on interest rates declining to bail you out, maybe we get my gut tells me we get 100 points of cut in the next year, that the economy really is slowing. We're seeing good anecdotal evidence it is slowing. And I think you will see interest rate cuts. I think you will see a slowing economy, but I don't think you're going to see more than 100 basis points unless Donald Trump just takes over the Fed and forces it.
Going back a little bit to, kind of as you grow out the private credit platform, how do you look at, co-investment or club deal opportunities with other private credit funds?
I think there are a lot of brilliant private credit funds that are out there. This has been a mainstream industry and it's attracted the best and the brightest to it. So when we were at Fifth Street, almost, I don't know, most of our deals are club deals with Solar, Pennant. Aries stopped clubbing with us because they ate their own cooking. But we had great club partners. Mass Mutual would come into our deals. GA, General Atlantic would come into our deals. So I think I'm excited to build back those types of relationships and do things in a club. We are right now going to be I shouldn't say we have a public company, so SUNS is public on Nasdaq. So I got to watch what I say a little bit. But one of our deals is a club deal. But we're talking about, and I'm not, and unfortunately they wouldn't allow us to use their names in the press release. But the biggest firms out there, and 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 that's amazing that we're part of that club in real estate lending. So I hope to do that also in private credit. But first thing I need to do was fire off from the private equity firms who used to be my clients, you
Hmm.
know, are you comfortable, right? Did we do a good job for you? Are we trustworthy? And they said yes. That was one of my. I was nervous a little bit. We're 7 years out. It's the same people though. And
Yeah.
then on the private side, the direct side, I think we have a terrific direct team to go do that. I've never had that business line in private credit, which is the smaller sponsors, the unsponsored deals. The asset-backed deals. Like that's a really interesting area where the big guys aren't playing because they're a lot harder to do. Only out of $1 billion of deals, right? Maybe you'll do 20 million of those or 10 million. The selectivity is so high in terms of, and when you do direct and sponsored, you get like 50 million. So it's a lot easier.
Looking ahead, we have a couple minutes left before we get to our final fun questions. But are there any, kind of unconventional areas or asset classes that you find, most interesting for either yield or, could be good to explore in the next few years as you kind of look to grow out the platform?
I mean, our head of the interval fund, who came out of Federated Kaufman and managed some money there, Pete McNett, likes music royalties, right? I think that's smart. But in order to do that, he's an expert, right? He understands
Yeah.
this niche industry really well. You have two major players. One of my ex companies at Fifth Street was an aviation company, so aviation leasing, and so I think that's opportunities in plane leasing and having an engine that just sits there and get rent from them from a good airlines in part outs, if you're going to go that deep in the structure. And you need that expertise to be able to do that. That was one of my best
Yeah.
returning assets when I was at Fifth Street. So bringing the niche businesses, the hard to scale businesses, are where you want to. If you're small, meaning a billion or 2 billion, right? If you're small, and that's amazing. I could say that, right? That a billion or 2 billion is this really tiny
Yeah.
firm in this behemoth multi-hundred-billion-dollar industry, right? Each firm is so big that you want to stay into the niche. You want to stay where the others aren't playing. You want to stay below the radar screen as much as possible and not join the $300 million club syndicates for a popular BSL, broadly syndicated loan. And
Yeah.
so that's where we're finding the opportunities. We're finding the opportunities where everybody else isn't, and we have the sourcing and people to go do that. And I think that's what's so fascinating, and so it's such an advantage to being smaller.
Is that what most excites you about, the next couple of years is kind of maybe exploring that part of the market that is maybe left behind in some ways, is might be the best way to say it, by because all the money's going up, the funnel, but they have these smaller companies that are, as you said, they're smart, they're growing, but they don't have as much access to capital as maybe the larger companies do.
I'm at a different point in my life. Yeah, I think at the firm, my partners, the CEOs of the business lines, are very excited for that. Me, I really want to grow great CEOs, like helping my partners be successful is where I'm at in life and investing alongside them. They're all killers. They're 24/7, work weekends, want to win and whatever it takes to win. And I love that for as an investor, that really drives, me want to give them money and bet on them and believe in them. And I do. And their teams are terrific that support them. But I get to coach them on like I just got out this valuation meeting. What is this thing, valuation? How do you do that? How do you build that process? And teach them, that why that's important to have NAV strikes daily, like we're going to do, and what that difference is, and I'm a chairman of 4 boards of directors, right? Dealing with all of the different boards, dealing with all the different opportunity sets, and looking at holistically all of our enterprise, which is very broad. We're tiny, we're still small at a billion something, but we're so broad with such great expertise that I get to look at real estate deals on one side, private credit deals on one side, opportunistic credit on one side, high yield on another side. It's really exciting for me to see everything holistically and see how they can all work together really well. And so, as an entrepreneur, this is like exactly where I want to be as a coach, as a mentor, as a helpful person, as a door opener for absolute brilliant killers that we have running these platforms. So I'm having a really great time, and I get to work alongside my son Adam, my third son, who is a partner here at TCG, and my wife. And so it really is a family-owned uh, enterprise that partners with excellent CEOs and entrepreneurs.
So we have just a couple minutes left, and thank you for being so generous with your time. I like to end with a little bit more lighter, fun questions. So,
Oh,
favorite
good.
sports team and/or hobby?
And or
Yeah.
my favorite sports team, unfortunately for me, is the Miami Dolphins. We're season ticket holders, and it's very depressing. The last game was a disaster. That's a horrible start to a football season. I'm going to be at the next game with the Patriots. We got to beat those guys. If we don't beat the Patriots, this Sunday, it's going to be a very long season, a lot of cocktails and the drinks. Um, you
I
wouldn't
should
know
tell
this
you,
if
I'm a Buffalo Bills fan, so we are division rivals.
you're in great shape
So,
compared to
so
us.
far.
I mean, Josh Allen crushed it last week, so
Yep.
he's really a superstar. What really amazing. Yeah, one quick Buffalo Bills fact is Quinn Early, who was an old receiver for the Buffalo Bills, went to
Yep.
my high school, Great Neck South,
Hmm.
and so it was. I mean, he crushed. I mean, we were the best high school team in the one of the best high school teams in the country when he was there, obviously.
Wow.
Yeah, yeah. I love the Buffalo Bills. Fina and Thurman Thomas and all those. I was in the locker room with them when I was 26 years old, and
Wow.
Marv Levy's last time. And so it's a phenomenal team and a phenomenal culture in Buffalo. We need that culture and team in Miami. So I
We
hope
just
we
got to
get
get
it.
over the hump. We
You
get
got me
right
down.
there.
You got me down a whole different angle here now with Buffalo. Jeez. Uh, and what they wouldn't know about me as a hobby is I'm a video gamer. I play games every day. I love it. It quiets my mind down. I love video games. And all these 10-year-old friends, 10-year-olds of friends of ours and couples like come to me and ask for video game advice, and it's really interesting. Conversing with a very different generation.
I would ask one surprising thing about yourself, but I think you just answered it with video games. So, what would be one book that you'd recommend reading?
I don't know. I read the Wall Street Journal and all these articles. I don't read a hell of a lot of books. I think Liar's Poker was one of the best books. If you haven't read, you have to read. And if you don't have a lot of time in your life and you want to read something very important, Who Moved My Cheese? It's an old book, right? But it takes you an hour. It's a little tiny book and tiny read. It's an amazing thing to get the hell out of what you're doing and what you're comfortable at and
Mhm.
challenge and go into the maze and go find out what's there. The other really cool thing I'll advise you to do, if you haven't done it, I don't know what you think of the guy, but I really like him as a guy named Tony Robbins. So Tony
Yep.
is truly an amazing person. If you get to go to one of his conferences, teach-ins, etc., coaches, you should do it. You should just go. Pick one, go. It's worth it. It may change your life. It may not change your life. Either way, the energy, focus, and understanding you get out of it's amazing. And he's just an incredible person. So that's my plug of something somebody should do if they haven't done it yet before.
A little more Tony Robbins in our lives is certainly not a bad thing.
No, I agree. I agree.
And then final question, one prediction for the next 12 months.
I think this bubble and complacency, and you can see that in the volatility indexes and the VIX and everything else, is ridiculous. And look, I'm a credit guy through and through, and I'm always early on my predictions, and I'm always wrong for quite a long time. My son Adam says, "How could you miss this run? And how could you miss this equity run?" And I'm like, I'm a credit guy. This is not my DNA.
Yeah.
Having said that, I've talked to so many brilliant people that we have access to, and we're really at a point of stupidity where five stocks compose 30% of the market cap on the S&P 500. That worthless stocks and meme stocks are created and worth a ton of money for no reason. Yes, they crash eventually, but still, this liquidity complacency will end. It always does. When it does, it's going to be ugly and deserved and create a lot of opportunities. And so those firms that have waited around for this opportunity, like Oaktree for a zillion years, Howard Marks has said this, by the way, for 7 years and been wrong, raising opportunity funds for tens of billions of dollars. He's going to be right eventually. And
Yeah.
he is, and it's going to happen. And so could it happen in the next 12 months? Maybe. I think it really depends on a whole bunch of events, but I think there's a real risk to the market. Jamie Dimon's talking about it now. If you can watch his podcasts and television, I think listen to Jamie and what he's saying at JP Morgan. There's real risk on the horizon, and people don't recognize it.
I think that's a perfect place to end, Len. Thank you very much for your time. You're very generous, so I really appreciate it. Continued success to you and the team at TCG.
Thank you, Todd.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.